100%. I pleased to say no symptoms whatsoever. Been coming into the office every day. There's a handful of us here, enjoying the peace and quiet and managing to get quite a lot done.
Okay, great. So you're one of the few with your letter in hand driving to and from work every day.
Yeah.
Thank you. I'd like to put on a bit of a long-term cap here to start. So with so much liquidity being pumped into global markets, do you believe this will have an effect on post-COVID-19 equity valuations, similar to what we saw in the wake of the 2008 financial crisis and the subsequent 10-year bull market? Or would you say it's rather premature to even begin to make such comparisons?
That's a really difficult question to answer, Dave. I read a really fascinating piece yesterday written by the same guy who argued both sides of the the potential outcome of where we could be heading. One quite bearish, and the other very positive assessment of it. So I would say it's way too early to tell. I would say, when there is this uncertainty, I always try and focus not on the things that you don't know, but focus on the things that you do know. So what we do know is, that we've had a massive correction in global markets, and if you look at the scale and extent of it, it's been faster than historically, events of this nature. If you look at 1987, if you look at 1998, if you look at the 2008 global financial crisis, the extent that and speed with which we've had the fall in equity markets has been much quicker this time than historically, but the scale of it has been as great as those kind of events. I think it would be naive to call the bottom now, but I would say you've definitely seen the majority of the hit already. To answer the question of the impact of the degree of stimulus that is being applied and the likelihood of it paying off, I think you need to analyze every country on its own merits. If you look at China, I would say the answer to that question almost certainly is yes. If you look at the United States, even though the amount of stimulus that has already been applied is double what was done in the global financial crisis, and recall in the global financial crisis it took a long time. It took them months of agonizing and arguing for them in steps to apply that, whereas here they've been able to move very quickly with the CARES bill that's been passed already. What the impact of that is likely to be, I think is impossible to predict now, but it's certainly been very impressive what they've managed to do. The American economy is extremely flexible in comparison to South Africa anyway, and so I would be relatively confident you'd see that come through. Where does this all leave South Africa? Well, I'm afraid not in a very good space. You'll know that we went into this event. I was looking. If you look at the chart, the sort of a 10-year chart of the JSE All Share Index, for 5 years since 2014, we'd been in that range between 50,000 and 60,000, and we'd got back down to the bottom of the end of the range in late February at that 50,000. And that was before the crack of COVID, which knocked another 20% off that, all the way down to the 40,000 level. It's bounced a little bit off that very low point. But the ability of our economy to bounce back, in 2009, you'll recall the balance sheet of the country. So we had been through that wonderful boom period between 2003 and 2008, where we had high commodity prices. We had a booming domestic consumer. Our debt to GDP ratio had come all the way down. We'd had tax cuts. We'd had our economy, our nation's balance sheet, the health of consumers was extremely strong, and so our ability to bounce back in 2009 was so much greater. Roll that on 10 years, and we go into this situation as pretty much a very ill patient who now contracts another severe disease. So, it's no wonder that the currency is blowing out as far as it is. The downgrade, by Moody's is really just, the final nail in the coffin, or it's not, it wasn't on its own, anything that was a great surprise.
Mm-hmm.
And so, the balance sheet looks terrible. The income statement, what's going to happen to tax receipts, and now, and our ability to respond with cost cutting, starting with the public sector wage bill, is extremely limited. So I'm afraid, while we've been pretty bearish on the South African economy for for about 5 years, it just got worse, and I don't see it having the opportunity to bounce back quickly.
In a rather convoluted way, should we receive some IMF money, would that create another sense of oversight over our government and maybe lead to something a little bit more positive in terms of change?
We can only pray, and that would be very good news. If we were forced to take out the IMF assistance, which came with very strong conditions around limitations on public sector salary spending, for example, that would be, I would say, a blessing to have that level of oversight, which we clearly don't have internally, politically, or the motivation to do so.
And then just bringing it back to the SA equity market, as South African equity investors, I guess it's been quite difficult. We haven't really participated in that 10-year bull market following 2008. In fact, I think since 2015, we've bobbled along rather sideways.
Yeah.
Do you think SA equities could finally start moving in step with global markets, or is the domestic economy just too littered with limiting factors and uncertainty to make any long-term views like that?
Well, I mean, you need to take into account the peculiarities of the construction of our equity market. Depending on which index you're using, as the benchmark to measure it by. So, you need to take into account that somewhere between 10 and 25%, maybe even more, is a single company, which is a Chinese internet business. The prospects for which look extremely attractive, and which you're accessing on a 50% discount by owning Naspers or Prosus, or a combination of the two. So that's the first point to make. Then the second thing is to say we've got a lot of great global businesses that just happen to be listed here and that carry quite big market caps, whether that's BHP Billiton or Richemont or AB InBev or Glencore or Richemont. You've got wonderful opportunities there to invest in global businesses, some of which we think have got great growth prospects. Others perhaps look a little bit overvalued, I would say. So we've sold all our Richemont, we've sold all our Bidcorp. We're quite worried about the headwinds fundamentally both of those businesses are going to face for certainly the next year as the full impact of COVID is felt on their businesses. But they are, the price of those assets is not set on the JSE, it's set on foreign exchanges. And cumulatively, that makes up about half of our total market cap. You take all of those, Naspers and those other businesses. So these are businesses that are global businesses. We're lucky to be able to access them on the JSE. So then you talk about the other 50%, which are our domestic businesses. Now, here there has been quite a lot of damage done. I would start specifically with the banking sector. So our banks are priced for recapitalization. Nedbank is the one that's been most dramatically affected. I don't know if you're aware, but Nedbank is trading on a dividend yield of 16.5%. This has never happened. This is half of the valuation at the worst point in the global financial crisis. This is a degree of hit to and Nedbank has just been the worst affected, but ABSA would be close behind. Standard Bank not much further off, and First Rand has been reasonable. That First Rand being the largest banking position we own in Rainmaker. And market indicating it's going to be the only commercial bank left standing at the end of this event. we think that's a bit of an over dramatic perspective on the world. Yeah, are we expecting credit loss ratios to rise? Of course we are, but they literally have to rise to multiples of where they got during the global financial crisis. And we saw how well the South African banking industry weathered that crisis. And the South African banking industry goes into this, unlike our government and our nation's balance sheet, with balance sheets much better capitalized than they were at the time of the 2008 crisis. So we think this is, we might be dead wrong, but we think this is a little over punitive, and we think that sector is arguably offering the greatest value, but clearly going through a tricky time.
So in terms of the banks, you mentioned First Rand and Standard are the two we overweight. Are you looking at adding a little bit more of Nedbank or ABSA, or is it a matter of sitting and waiting?
We've added to both ABSA and Nedbank. So and there was a wonderful trading opportunity a couple of weeks ago in Capitec. So we own all the major banks at the moment. We even own Investec as well. So our total banking exposure in the portfolio is about 13.5% of the portfolio. If you look at the JSE, it's about 12% of total market cap. So back to that point, sorry, I was making about where's the domestic world going. So that a lot of the domestic stocks have been priced for failure, some of which we may see. Whether you're a motor car dealership, Motus is trading on a PE of 2. Historic PE of 2 anyway, but you saw vehicle sales for March were down 30%, so they will not make any money this year. They may even make losses. So that's also an extreme example. Anybody who's involved in any kind of manufacturing, a small business like Udeco, I can think of as a good example. That's a small holding in the Entrepreneur Fund. Our retailers, certainly on the discretionary side of things, have been absolutely massacred. I expect some of you have heard that very emotional voice call with Grant Patterson of Edcon, explaining to their suppliers that basically they're not going to be able to honor invoices in the next month. We don't like the property sector at all. We haven't had any exposure. We've had a very small exposure only through Growth Point. We haven't owned any of the other stocks at all for the last 3 years, and we don't think that situation is likely to get any better, notwithstanding the tremendous falls you've seen. So we think there's a lot of pain still coming for the property sector, and obviously there will be some knock-on impact of that to the banks. So I think that's really tricky, is around domestic businesses, who's going to survive. Obviously the food retailers are a good place to hide, and they've been relatively resilient. We own quite a big position in SPAR. We don't own ShopRite. We have some concerns around that business's balance sheet and its exposure in Africa, Angola and Nigeria specifically. A business like Vodacom, we own a big stake in. That's been quite defensive.
And then someone like Woolworths,
the food producers, Tigers we don't own, but we've got a big position in AVI. So they've been relatively resilient.
And then someone like Woolworths probably felt a little bit more pain than the pure food retailers, because of the tale of two stories in terms of the food and the clothing as well.
Yes. So I mean, Woolworths obviously, SPAR is the perfect hedge, whereas Woolworths, you've got the combination of three things. You've got their food business, which is outstanding and will continue to be okay, but it's only about, now it's probably a third of earnings, maybe 40%. And then you've got their clothing business, which has been through ups and downs, hasn't really been doing particularly well. And then there's the albatross of David Jones.
And then another interesting little stock is Oceana, which you've held for some time.
Yes.
They do the canned pilchards, and they have the Daybrook facility in the States as well.
That's right. So this is a really, great a company in a great position. So essentially there are three parts to the business. If I start with the biggest, which is a business in the US called Daybrook that catches an industrial fish called the Gulf menhaden, which is processed into fish meal and fish oil, the majority of which goes into the pet food industry in the United States. So we expect that business to continue and has continued to operate completely uninterrupted. And of course, it's a great rand hedge for us South Africans. Then you've got their business here in South Africa, which cans pilchard, and you'll all be familiar with the Lucky Star brand, which is a dominant player in the industry. Obviously, that's going to be a relatively cheap source of protein for stretched consumers. We would expect those volumes to grow, and the raw material that goes into it, they source from all over the world. It's not dependent on whether the South African fishing vessels are going to sea or not. So they can continue with that supply chain, whether there's any fishing going on in South Africa or not. And then the last bit is their horse mackerel business, which is in Namibia, which has had a bit of a tough time for the last few years because the Namibian authorities have been behaving quite badly, as that typically happens. But they're a dominant player, and they're an integral part of that industry in Namibia. And the situation has been getting a little bit better in recent times. So that business, that piece of the pie might not have a boom time, but it will be okay. You know, you put all of this together, it's a wonderful defensive place to hide.
Yeah, it's nice talking about these little stocks that investors won't usually hear about. But I'm going to bring it back to Naspers, which you mentioned briefly on the previous question. And I think one of the immediate things that investors will notice when the March numbers do come out is the higher Naspers / Prosus, or Tencent, as you may say, exposure in the fund. So have you strategically added some of this, or is this just a matter of where the shares risen 7% or so year to date that it now makes up a bigger chunk of the portfolio?
It's all been through relative price performance. We haven't added to it. In fact, you know, not just you. I mean, obviously the size of the position is a function of how attractive we feel the business is in the context of its growth prospects and its current pricing. The discount is obviously a source of massive frustration to us as shareholders, but we would hope that the events of the last few months give us some ammunition to continue to address that quite aggressively with the board of the company and look to pursue more aggressive ways of unlocking that discount. Obviously, it pushes up very hard against, from a risk perspective, being at this sort of size of position in the portfolio around our tolerance with respect to position size. So I just want to reassure you that that is not something that we are not taking into account or appreciating with appropriate seriousness.
Okay, thanks, Ant. Another stock which has been quite interesting from a positive side is British American Tobacco. In similar vein to Naspers, up around 7% year to date. I think the bulk of that was actually in the last month or so. I was very, well, of a side note, interestingly reading an article yesterday about one of their subsidiaries being one of 20 global companies clinically or pre-clinically testing a COVID-19 vaccine. I'm not sure whether this will be written into any of your models, but have you heard about this?
I have, yes, and we had some contact with the company yesterday on the subject. I don't know if you've seen the little video clip where Kingsley Wheaton, who's one of the executives, explains, you know, the relative benefits of being able to grow these cultures in the tobacco plant itself, which is much quicker turnaround time relative to some of the other ways, biologically of doing it using chicken eggs. So it has a distinct advantage in that regard because the rate of extrapolation is substantially faster. So who knows? This is also not something, as he pointed out, that they're suddenly jumping on the bandwagon about. So in their R&D and all of the scientific work that this company's been doing for a decade or more already, they've been working with the FDA around vaccine testing. So this is really just an acceleration of some work in that field caused by the events of COVID-19 rather than them suddenly trying to jump on the bandwagon and seeing it as an opportunity for a tobacco company to be seen to be doing good.
Because I guess tobacco has always been something that some investors struggle with ethically, but if you looked at British American Tobacco, they're quite progressive in putting a lot of money in terms of R&D into next generation products. In your engagements with them, have they been forthcoming with this and really displayed a willingness to evolve their own products as well?
They certainly have. They have made the argument that that nicotine consumption is not something that is an unhealthy activity, and the FDA agrees with them in that regard. The problem is the delivery mechanism by which consumers are accessing the nicotine. When it's delivered through a combustible cigarette, there are health risks around doing it in that manner. So, and worldwide, the volume of nicotine units continues to increase on a per capita basis, and the population has been growing. So it's a very exciting growth market. The challenge has been to be able to provide a mechanism of consuming nicotine to consumers that doesn't have negative health consequences. We understand that what those are with combustible cigarettes, but that's a very appealing way for consumers to consume nicotine units because the delivery is so instantaneous. They have been working for a long time. They're investing nearly £1 billion a year. This is in a company that has turnover of £25 billion. So it's a substantial investment that they're making every year in R&D around developing their reduced risk product portfolio. Now they've got a range of mechanisms in this regard, from combustible cigarettes, then tobacco heating products. Their product is called Glow. Then would come vapor, and you'll be all familiar with that product. And then they have a product which they broadly describe as modern oral. So in the United States, you will be familiar with chewing tobacco. So they own the biggest brands there in chewing tobacco, but that's also, there are some negative consequences to that. So modern oral is something that actually comes out of Northern Europe. You may have heard of a product called Snooze. So it's a little white pouch. It looks like, if you buy a bottle of vitamin C tablets, there's that little pouch at the top to absorb all the moisture. It looks like that, and you pop it into your mouth between your lip and your gum, and it releases the nicotine very powerfully, actually. Now, this is another new product that they developed that has been incredibly successful in Northern Europe and now the United States as well. So their philosophy has been to migrate consumers but they're also not trying to dictate to anybody to say, if you want to smoke cigarettes, that's your choice, but you must be aware that there are potential health consequences. But you're a grown adult, you must make up your own mind. But there are healthier alternatives, and we offer all of them. And we particularly like that about BAT. In comparison, if you look at a business like Philip Morris, who's the major global player, Philip Morris are all in on their old combustible cigarettes, and then IQOS, which is a tobacco heating product. Now, IQOS has been very successful in Japan, but it hasn't been very successful anywhere else. And so BAT is saying, we don't know how consumers will choose to consume the product. We will just offer all of the avenues, and we think that's the right strategy.
Okay, thanks, Ant. I think we only have a handful of minutes left, and it's definitely worthy touching on some of the stocks which have been disappointing year to date. The Aussie's down, mid-20s. I think Rainmaker's in step with that. So which stocks have been overly disappointing? I mean, there's obvious elephants in the room there, Sasol, but any others that you have potentially sold or continue to hold because the investment thesis hasn't necessarily changed during the sell-off?
So the two things that have hurt us so far this year have been our banks exposure. I think we've discussed that, and we're sticking with that. And then the second one has been Sasol, which again I'm very happy to talk about, but that's probably another 5 or 6 minute conversation on its own.
Mm.
So those are the only two things that have hurt our performance. Whereas, I'm very pleased to say we've had, very big exposure to some real winners.
Mm. So the Sasol position remains, the size at least remains the same. It wouldn't have necessarily been prudent to sell the stocks at current levels.
Well, now it's down to less than 1%. I'm looking at the portfolio this morning with the stock up 20% yesterday. It's risen from 0.75 to 0.9%. So as you know, it's moving around by 20% on a day. Sasol's market cap is down to yesterday it was sort of 27 billion rand. I'll tell you today it's 25 billion rand. Okay, so that is that's like $1.2 billion market cap, and it's got $12 billion of debt on the balance sheet. So it's priced for failure. We see it really as an option on the oil price, and we don't think that the oil price stays at $25. We think we think that this is a business that South Africa and the world needs. If Edgar's goes bust, South Africa will be fine. Steinhoff goes bust, no one cares really. We don't really need another furniture retailer. What we do know is that the banks will survive. They have to survive. Sasol produces 42% of the liquid fuels that are consumed by our economy. It's the biggest employer in the country and the biggest taxpayer. Sasol is not, Sasol's like Eskom. We can't live without it. It has to survive. We can live without SAA. We can't live without Eskom. And Sasol is much the same. So we've listened to the strategy of what they're going to do. We think it's rather like Anglo's was in 2015 at $50, with a balance sheet in trouble. Yes, the balance sheet is in severe trouble, and it just got worse with the oil price where it is. But what do? You have to focus on what you do know. We do know that there's a plan in place. We do know that they can push back against the banks, because the banks don't want to own the equity of this business. They don't want to look at the losses, so they're going to have to relax their covenants, just as many other companies are forcing banks to do. And Sasol is big enough to be able to do that. They're not some little small cap, retail business that where the banks will say we'll just push them into insolvency. They will have to come to the table, and Sasol have got a credible plan around debt reduction program. It may require bringing in an equity partner into parts of Lake Charles, and depending on where the oil price is in 6 months' time, it may require some additional capital from shareholders. But for the time being, we think that they can resist that pressure.
Okay, thanks for that, Ed. I know you and your colleague Campbell have done a lot of work on Sasol, and I appreciate your thoughts on all the other stocks as well. I think we could spend quite a lot of time delving into the portfolio, but we touched on some of the key aspects as well as some of the smaller holdings which still offer quite a lot of interest. Unfortunately, we do have to finish the call at this point. So, yeah, Ed, thanks for joining us today. Really appreciate it.
Thanks very much, Dave. Thanks for the opportunity. Thank you all for your interest. If anyone's got any follow-up questions, you're welcome to contact me directly, and thank you for your ongoing support. We certainly appreciate it, guys.
Thanks, Ant. And then, of course, thanks to everybody who dialed in this morning. I'm sure you found Ant's insights incredibly useful. A reminder that this call, along with the previous ones, have been recorded and are available, so please do get in touch with your Nedgroup Investments relationship manager should you wish to have these. And please do join us again next week, where we look to chat more in depth on our local and global property fund, our cash solutions products, before ending off on Thursday with Jeremy Lang of Ardevra, who will be dialing in from London to give us some insights on the Global Diversified Equity Fund. And with an investment philosophy grounded in cognitive psychology, I'm pretty sure that you'll be particularly interested to hear his views on the current state of global anxiety. So from me and Anne, thanks again. Take care and keep safe.